Our last speaker is Jeff Kench. He's going to be speaking about new carbon, carbon insurance for the new economy. So, take it away.
Great. Hey everyone, great to be here. Thank you for your time. Thank you, Kim. I think this is a pleasure to me to be at this conference because I'm a boring insurance guy, and it's nice to meet real people with real jobs. So look forward to talking to you at the break. My name is it's James Kench. You can call me Jeff. I don't mind. I'm head of insurance at Kita. So at Kita, we insure carbon. So we build insurance products to de-risk high-quality carbon removal to help them to scale. And we believe insurance is one of the keys to unlock the financing that we've been discussing so far today. We also think it can act as an extra layer of due diligence and also a stamp of confidence to give the ability for buyers and investors to take action. And we're looking at how do we use insurance to solve some of the pain points of the market as it scales. So to do so, we look at the life cycle of carbon credits because we think credits are a key financing mechanism, and that's where we focus. We look at the different stakeholders, so the sell side, the project developers, the buy side, the investors, and also the intermediaries that enable everything to work. And we also look at all types of carbon. So we focus on nature-based, but also engineered, enhanced weathering, direct air capture, and biochar. So great to be here. Just a quick overview of the agenda. The purpose is to share what we see as carbon insurance at the moment, how it can de-risk biochar, and some thoughts on how to make it a bit more insurable, building on what Ryan and Melissa were talking about already today. A quick snapshot of why we're here and what we're about. We want to see carbon projects scale. We want to see them make them bankable via insurance. That's obviously important for the climate change fight, but also it's a great investment opportunity. We focused on the carbon credits because we see there's a lot of risk there, and that risk needs to be could be transferred via insurance. How we do that is via insurance products focused on the voluntary carbon market. By reducing risks and adding some quality checks, we hope that enables clients to take action. One cool thing is we can actually pay out claims in cash, but also in carbon credits as well. The WHO, for now, we focused on the buy side, so making these projects insurable, therefore bankable. So we focus on investors and buyers, and I'll go into our main product, but our goal is to be a one-stop shop for the whole carbon markets and the whole ecosystem. And then the when is now. This is currently being uninsured, and we think credits are an asset that should be protected. And if you're buying credits or selling credits, you're buying and selling risk. So therefore, hopefully we have some value to add there. Very briefly about us, we came through Lloyd's of London. We're an alumnus of their innovation lab, and we're backed by some of the leading global reinsurers. So we're not only part of Lloyd's and have their credit rating, but also firms like Munich Re, Renaissance Re, and Chaucer. So one of the values we can have is adding that kind of credit rating to our insurance policies, particularly for financing purposes. Just a very quick dive about why insurance is important. Insurance is part of a risk management strategy. The goal of insurance, or the purpose, is to help swap out that uncertainty of what future losses might be with the certainty of an insurance premium. And then our role as the insurance industry is to assess and price the risk and then provide risk transfer mechanisms for the players involved. Risk management it's key to be aware of it, to identify, assess, reduce, as Melissa was saying, avoid the very high severity, high frequency risks, accept some as a cost of business, but where insurance can play is for those low frequency, high severity events. And as mentioned, if you're buying credits and you're buying risk, and if it's a very large purchase or a large part of your business model, then it's something that you should consider for whether insurance is applicable. Now, just to put that into the context of carbon credits themselves, and then into biochar. So when we think of the carbon credits are intangible, but the actual value derives from both the physical asset and the intangible asset itself. So we look at both sides and try to bring into all these risk factors into our models. So on the physical side, there's natural catastrophe risks, so your classic fire, flood, windstorm, hurricanes, etc. Underperformance of the project could be through like we're talking about lack of feedstock availability, supply chain issues, and also the operational machinery efficiency or breakdown. On the intangible side, that's when we get into some of the more nuance of the carbon markets, working with the standards, what is the forecasting, the MRV, the monitoring, reporting, verification on these projects, and also the permanence or invalidation and the usage of these credits, and whether there's a risk that is reversed somehow. We kind of categorize these into 6 key themes there, as well as reputational risk, and I'll just kind of break down these at a general level in carbon, and then go into biochar. So this is a little bit busy, but basically we see this is the life cycle of a carbon credit from cradle to grave. There's 3 main phases. There's the concept phase, scoping out the project, getting the financing, getting the go-ahead. There's the execution phase, actually doing the carbon capture and removal itself, and then the retirement phase, i.e. the credits have been issued, they're either being traded or they're being used by corporates to offset and being retired. Reputation is a pervasive issue, particularly for corporates. They want to do the right thing. They want to buy high-quality credits. They don't want the risk that their name's going to be dragged through the front page of a newspaper for investing in a project which then turned out to be not doing what it said. But it's hard to ensure a reputation. But we think insurance adds an extra layer of protection for corporates who are saying, well, I wanted to do the right thing. I really did my due diligence. I bought the high-quality credits, and I bought insurance on that, so that if in the remote case there is a loss, then I'm made whole, and my stakeholders are going to be happy with my approach to that. So just to quickly break down those risks, non-delivery is the one that we focus on particularly. So that's the risk that the credits that are expected or promised from a project are not delivered in part or full, and I'll walk through our product on a later slide there. Price is obviously important. Market prices are turbulent and going up and down. Reversal risk, less relevant for biochar, so that's the risk that the carbon captured is then released. In forestry, if there's a wildfire, the carbon literally goes up in smoke. With direct air capture, if the carbon escapes from a leak after it's been injected underground. I think with biochar, it's just if there's a change of use. So it's the biochar has been produced, there's a physical off-taker, but then they go off and burn it in some form. Counterparty risk, so the risk that the parties we're contracting with default on the contract and don't fulfill their obligations. That's quite a key concern in the voluntary carbon market because it's not regulated and it's still early stage. And then there's a lack of standardization of contracts and everything there. Political risk, this is more for projects operating overseas, particularly in the global south. So the risk that the host country either doesn't allow a project to proceed or they prevent that project from exporting credits internationally. And we're just building a bespoke insurance product on that at the moment, particularly for the forestry type project, nature-based solutions, but also biochar internationally, direct air capture, etc. So these are the key themes, and they're all relative. This is not to scale, but just we wanted to show how they evolve over the life cycle of a credit and where we currently play. So we have what we call a delivery risk product that covers investments from concept to sort of the issuance phase. And once the credits have been issued, then we have a product that covers the invalidation for any potential fraud or negligence in the process that the credits were issued. So just to touch on that non-delivery, we call it carbon purchase protection cover. So if you're a buyer or an investor and you're prepaying, as Ryan was saying, credits for X tons of carbon at Y dollars a ton for delivery at date Z in 1, 3, 5, 10 years, then if that buyer or investor doesn't receive those credits when they're due, then our insurance kicks in, either in cash or in carbon. And then the actual underlying trigger for this could be anything. So we were thinking about building an insurance product for specific risks like fire risk, flooding risk, drought, that kind of thing. But all the investors we spoke to said, well, we don't really care. We want the delivery. So we structured it that way. And the way we think about the main risks are there's avoidable losses, unavoidable losses, and then shifts to the carbon standards. Avoidable losses would be the default of the developer. So if they go insolvent, if they run out of cash, if they abandon the project or change course into what they're doing versus what was promised. Unavoidable losses would be your classic insurance losses, so fire, flood, earthquake, all the usual stuff there. And then the shifts to the carbon standards if the methodologies change and you thought you were going to get 100,000 credits, but that change means it's only worth 80,000 or zero. The only thing that we don't cover is that political risk, and therefore we get asked about it a lot, so we're building that now as we speak. Just very broadly how we think about underwriting any carbon project, and then I'll go into biochar specifically, but there's 4 key themes that we think about, starting with the project itself. Where's the location? So what is it physically exposed to from a weather and a natural catastrophe element? What's the type of carbon project? What's the methodology? What's the MRV on the project? Are there any credit ratings? Yesterday we had B0 speaking, so are there any credit ratings on that project or from that developer or from similar projects in that area or that type of carbon? We look at the project developer, so then that goes back to that avoidable loss element. So what's their financials look like, but also what are their operating experience? Is it brand new? Do they have familiarity with biochar? Do they have other projects? Obviously, it's a nascent stage, so there's not that much experience at the moment. Hence, there's that risk, but it's just something that we're building up a sort of a library of. Carbon contracts, so the actual purchase contract for the credits themselves. If there is a claim, then we pay out as the insurer, but we also have the right to sort of step into that contract to seek recovery. So we look at the terms of that contract to see how tight they are, what are those rights of recovery, and then importantly, is there their ability to recover credits from other streams that project developer may have. Less relevant in biochar at the moment, but in the forestry space, if I'm developing many forestry projects, I might have several streams to draw from. And then lastly, we do due diligence on the buyer themselves as well. And that's really just to understand why they're buying the credits and what they're going to use them for. The why is more around what's the sort of integrity of that purchase. Are they just buying the credits to sort of tick a box and it's sort of lowest quality, lowest common denominator, and if there's a loss, then they're going to immediately make a claim, or are they really kind of looking to buy high quality credits? They're going to be a repeat buyer, they want it, they're concerned about their reputation, etc. And then what are they using it for? Are they using it for their own account, i.e. their net zero or net neutral strategy, or are they reselling it on as a market builder in that space? So that's just very broadly for a carbon project, any carbon project. Just to drill into for biochar, and Melissa did a great job explaining these risks. And actually, we worked with JECA last year to build out our due diligence method for underwriting these risks. So we see 4 key themes from an insurance standpoint: the feedstock, machinery breakdown, facility fire, and then the kind of usage risks. Feedstock, again, I think it's been mentioned, but supply consistency, proximity, redundancy, alternative sources if there's a loss, life cycle analysis, preparation, moisture content, and also the operator familiarity with that feedstock. So whether it's sawmill, forestry, sugar, etc. The machinery breakdown, this is coming into a bit more classic insurance land. So key things there are: who's the manufacturer, how was it installed, was it installed on site, or was it modular? What's the maintenance like? How often is it? Are there any regular checks? Is there like IoT sensors to kind of see how the machine is performing over time? Also looking at where the machine is located. So is it co-located with quite a dangerous part of the potential feedstock? So like right next to a sawmill is a little bit of a concern, or is it a standalone machine? Emissions permits, site acceptance testing, all that good stuff, and then redundancy. So if there is a loss, is it just one machine? Do they have a couple of machines? And what are the availability to get repairs done quickly, etc. Facility fire, again, like classic insurance stuff. So the building where it is, how easy is it to burn? Is it wood frame, or is it steel, concrete, etc. But then how does the project developer ensure to reduce that risk. What's the housekeeping in terms of hot work procedures, dust control, thermographics of the feedstock, so just making sure they're monitoring that so that the feedstock piles don't get too hot and start a fire. Fire detection, smoke alarms, early warning systems for overheating, automatic shutdown abilities, and then fire protection, fire hoses, water supply, proximity to the local fire brigade, and all that good stuff. And then just a couple of nuances around there. Dust is the main killer. So sawmills, there's a lot of dust. Sugar can be a lot of dust. Nuts, of course, and corn. Rice, there's the sort of potential molding of rice husks. They kind of generate and build up their own heat and spontaneously combust. So temperature monitoring is key for all those things, as well as extracting of the dust in the environment. And then back to market uses. Here there's a bit of a mix. So the physical offtakes is a key one for us. There's two sides to that. There's the side of additionality of the carbon credits themselves. So would this project have happened if there wasn't a carbon credit element, that's key for additionality. But for us, the main risk is really a kind of credit risk of the project developer. So if they have diverse revenue streams, so they're not just reliant on credits, they're not just reliant on the physical offtake, they're not just reliant on the kind of heat or waste energy, those are pluses in our mind. So it was a bit of a whistle-stop tour. I know Melissa did a great job covering a lot of these risks as well, but I think the key thing is insurers will be thinking about this as well. The more we can get comfortable with these things, the more of these boxes are ticked, the lower the risk, and therefore the more competitive and the lower the price of the premium, and then also the more comfort that investors, buyers, etc., can get with the project. So just to kind of round off, it's a proper risk management approach is really key. You want to avoid high severity, high frequency losses. You're not going to have a biochar plant on a volcano, but how do you reduce the risks that are inherent in the business? And the insurance industry happy to work and advise on what we would like to see, and therefore tick some of those boxes. But then insurance is there for those high risk events, so the natural catastrophe, the supply chain risks, machinery breakdown, and some of the nuances of the carbon market. So if you'd love to speak more, if you'd like to learn more about that, I'm happy to answer some questions.
Hear it?
Yeah, I mentioned the importance of physical usage, just to elaborate on that. So for us as the insurer, the key thing is what are the revenue streams coming from not just the credits, but the physical offtake. So if it's just a great project, great char, but then it's just going to waste, then that's a sort of lost revenue stream for the project developer. So therefore, they may be more reliant on the credits and the vagaries of the credit market. So that increases the risk for us. Whereas on a carbon additionality element, you'd almost prefer there not to be a physical offtake, because then they're more reliant on the credit, and that makes it more additional. But for the risk perspective, a more diverse income stream is a good thing.
Thank you. Next.
Do
you want to repeat that?
So just, I guess my take was it's a question on the EPC and how do we see that, the role of insurance in sort of wrapping around that. So from our take, our first focus has been on the buy side. So how do we de-risk the buyers or the investors or the lenders to deploy capital, make those projects bankable? And to do that, we need to understand the risk coming from the developer side and the machinery. We're looking to build products to do the same or take some of those risks from the developer side. And one of the key ones there is that sort of technology performance insurance, so that whatever warranties you may have from the manufacturer, there's scope for insurance to kind of wrap around that to say, well, we have an ideal level of output. If that drops from either reasons beyond our control, then insurance has, there's potentials to structure insurance that will say, well, we'll kick in and make you guys whole on that front. Yeah, so the way we look at it...
Could you repeat it?
Oh, sorry, yeah. So like cost of insurance, I think is... Yeah. So for us, the key metric is just, because we're insuring the credits, it's how many credits there are times the value that they're purchased at equals your total sum insured, as we call it. And then we just apply our rate to that total sum. ballpark for us, biochar is a great risk compared to some of the other carbon projects. It's actually a lower risk than others, but ballpark, it's about sort of 1 to 2% of that total value per year of coverage. So if it's a 1-year policy, then it's 1 to 2% of that sum insured. If the purchase of the contract is over 4 years, so buying now for delivery in 4 years, then it'd be a sort of 4x multiple of that. But the sweet spot seems to be for biochar as short as 6 months, but up to 18 to 36 months as well. And then in nature-based, it's multi-year, it's like 5-10-year projects as well.
Go ahead.
If I understand correctly, what you're talking about, you're everything you're talking about here is delivery insurance. So if we pre-sell, making sure that we deliver the credit.
Yeah.
You also talked about there being then, I guess, making sure that it doesn't revert, right?
Yeah.
Did you touch on that here at all, or can you insure on that? Did I miss that, or is that sort of separate thing?
Yeah, I mean, we don't. So we cover at the moment until issuance of the credit. So that you've paid for something. If you don't get it when you're due, then that's when we make you whole. Once the credits are issued, then we do have a product for invalidation of the credit. So that would be more for the nature-based solutions where the developer in country X sort of misstated or lied about what they were doing. That could apply to biochar as well. And then on the broader reversal risk, particularly for nature-based solutions and DAC, then we're just looking at that now. We're building a product to cover that, and that could be either something that corporates want to buy, could be folks that have portfolios of credits that are sort of trading them. Also talking to some of the carbon standards, they maintain a buffer of a kind of self-insurance mechanism to maintain the integrity of their standards and registries. So we're talking to them to say, well, actually insurance could be a way to give a bit of a backstop to that as well.
How would you say thank you for playing a very important role in
Again, please repeat the question.
Oh yeah. Okay.
Yeah.
Well, no. Thank you very much. We're.
Oh. Yeah. Sure.
Yeah.
Yeah, there's usually somebody who does that, but I guess that
Yeah.
person's not here today.
Bro.
Oh, thank you.
So I noticed you're utilizing primarily reinsurance carriers. So do you guys pay claims only in cash, or do you carry an inventory of credits yourselves, or?
Yeah. Look, long term, we're looking to build our own credit reserve. So we would hold a reserve, and then that would allow us to kind of hedge some of the market price risk that is out in the market at the moment. Short term, what we do is we have a preferred supplier pool. So we run a tender an RFP last summer. We've got 4 kind of the big name, mainly nature-based providers at the moment, so that if there was a claim, that sum insured, the X number of credits times Y number equals the claim amount. We then convert that with our partners to try and execute on that on the spot market, but with preferential rates. And then the good thing is the claims process will take a little bit of time just to adjust to make sure that we measure and value it correctly. But then we'll have advance notice that it's coming, so we can kind of pre-warn our panel to say, we have potential claim of this amount. We may need these types of credits. The key thing, though, is to know what credits that the buyer is looking for, because there's no fungibility of those credits. So the way we get around that is to, upfront with the purchase of the credit or the policy, to say, what's important to you? Is it type of carbon? Is it quality? Is it geography? And we go through like a waterfall best matching process, because it's unlikely that the exact credits they want will be available when they want them. But we want to make them whole as best as we can, and if we can't, then there's always the option to pay out in cash. But yeah, long term, we're looking to build a reserve, but insurance is a regulated space, so there's a lot of hurdles to jump on that front.
So just a quick follow-up. Are you guys contemplating moving into captive structures, so more self-funded risk in some regards?
Yes. So we're working actually with a couple of captives now. So Captive is a corporate's own insurance company in-house that takes the lowest tranche of risks or risks that can't be really taken to the insurance market. We like to partner with them because it's a great way of seeing the client participate in the risk. So if the captive's involved, then they're taking a slice of that risk, which means their interests are aligned with ours, which is great to see. And then they may not have the experience of pricing and assessing that risk because they need to assign a notional premium into their captive, and we can help do that. So yeah.
Last really stupid question. Is this considered property and casualty? What is this?
In the US, it's considered excess and surplus lines, and it looks and feels like a credit insurance policy. So our base underwriting model is built off credit insurance rates, and then we either discount or load for some of those factors we went through. But it's structured around a non-delivery of an intangible asset, but it looks and feels. If I take it to the insurance market, a credit insurer will say, right, that's credit insurance.
Thank you for explaining everything today. It was very interesting. One thing I wondered about, I understand the products that you described for the buyer insurance. Is it something that Kita would ever want to do, or anyone else in the industry, to provide insurance for the seller for price, to have some price assurance for the credits they're producing?
Yeah, I think we struggle with taking on that basis risk. The way we get around it now is to say, if the purchase of the pre-purchase or delivery is multi-year, then we'll agree a set amount that's insured in day one. But because it's multi-year, like every year or more frequently if they require, we can review those limits. So it might be, well, the carbon price has drastically increased, therefore I think I'm underinsured. So happy to have that conversation to sort of increase the cover there. And then longer term, if we build up a credit reserve, then we might be able to sort of hedge that price risk, because whatever's going on in the market will happen to our reserve pool as well.
Anyone else? James, thank you very much.
Thank you very much. Thank you. Yeah, great.
Biochar.org appreciates the support of our sponsors, exhibitors, presenters, and attendees. We look forward to seeing you at our next conference in September 2025.